You asked, so we delivered. Ben Clark from TMS Private Wealth is here with us. He's also part of the Ausbiz Investment Committee, if you're unfamiliar with that. He's here with his 3 stocks for, something we haven't, I don't think at least, have asked him for quite a while on ausbiz.com.au. Ben, welcome.
Thanks for having me.
So I'm going to pick your brain, what you actually would buy. So let's talk about founders, because you've picked a theme which is pretty interesting. Don't give up on founders. And all I can say is some high-profile founders have not been covering themselves in glory as of late. Have the headlines not had you guys at TMS Private Wealth sort of rethinking, what it means?
Well, I think, look, it's a good lesson in that not every way of investing is perfect. And, we own WiseTech and Mineral Resources, and it hasn't been an easy time, because I think the lesson out of it is when things do go south with a founder, as opposed to a more traditional CEO, it can spiral on itself a lot faster than you'd expect, as we've seen in both those cases. But I still think across a diversified portfolio, it is absolutely where you want to be. You want to be backing the best and smartest and most driven and most incentivized people to continue to build wealth for shareholders. And so I thought it was kind of a topical theme, because we've heard probably for the last 10 years, I heard your previous guests talking about backing founders. There's been a bit of uncertainty created this year by what we've seen.
So I'm just curious as to the processes at TMS. So has the fact that you've been burnt by MinRes and WiseTech, you brought them up, I didn't, has it caused you to go back and rethink and stress test, I guess, your exposure to those companies that are founder-led?
Absolutely. And I think, in one case, we feel we're well through the worst of the news, which is WiseTech, and we actually see a lot more upside, particularly with this acquisition that they've just announced. With the other one, it's still very much a work in progress. And I would say the issues Mineral Resources are facing at the moment are less to do with the founder. They're more to do with the balance sheet, the road, that a key infrastructure component that they've got, which needs to pay down that balance sheet. But I think what it did highlight in hindsight for us was that if the founder hadn't been going through some issues earlier this year, we might not be facing the issues we are now, because they might have raised capital, which I don't think they would have been able to do earlier this year because of all the uncertainty that was surrounding the business. And that is a good lesson to learn. So, you never stop learning in this industry. You've got to keep learning. But you also have to continue to think about the weight of probability. And, I think for WiseTech, it's still been an extraordinary investment for us where it is now. MinRes is a struggle. Okay.
So we are going to talk about 3 founder-led stocks. But just before we get there, so how do you guys determine whether this is a positive founder story? And I suppose I'm trying to get at, do you guys have face-to-face with management? How do you go about things?
Yeah, well, look, that's a good question, because I would say we're typically invested in around 20 to 25 businesses on the ASX at any one time. And we've probably got about another 20 that we would say are on the bench that we keep pretty close tabs on. But for whatever reason, they're not in our clients' portfolios at the moment. And all 3 of these, I would say, have been on the bench for some years now. And what that's meant is that one of us is listening to their earnings calls, going to their investor presentations, following all of the analyst notes on the company that we're looking at. And so it's a way to build up like a track record, to start to think if you trust the person that's running the company, what they said they'd do, and whether they actually delivered on it or they exceeded it, or, you start to build up a bit of a track record of, who you're listening to. And, when you look at companies on the market, there's always like this urgency to go and buy them. And that's probably one of the hardest things not to do, because you can see something that's attractive. But that's kind of our process, is to build some in-house knowledge on the business, but more importantly on the people that are managing the business.
Let's cut to the chase, shall we? So Macquarie Telecom is one of your...
Technologies.
Oh, sorry. Technologies.
Used to be Telecom.
I'm sorry. Yeah. Oh, Nadine. I just was sort of smiling because Governor Macquarie is obviously one of Australia's founding fathers, if you want to call it that. So living up to the name. So it's it's a dual founder. It's brothers, isn't it?
Yeah, well, look, the main founder is David Schuderhope, who still is running the business, and he owns 41% of the company. So this is, I would put this company in like that Soul Patts, Brickworks. It's been around for years. It doesn't get talked about a lot. It's quite illiquid because it's so tightly held by David and a number of fund managers. So it doesn't turn over a lot of stock each day. But it's been an incredible success story over the last 20 years, 10, 20 years. Had a rougher time this year, which we can talk about, and is one of the stocks that we were buying with this pullback that we saw around Liberation Day.
So why? Yeah, because it's in the data center space.
Yeah.
It has government contracts.
Yeah.
What's the problem here?
Well, I don't know if we can bring up a longer term chart, but the problem...
Not today.
The problem in the short term was that there was way too much enthusiasm about data centers over the last 6 to 12 months. And if you look at Goodman Group, got to $40, NextDC, nearly $20, Infratil, and this is probably the fourth one that you can play the thematic. And you'd see very similar share price charts over the last 12 months. So part of it was just, I think, investors earlier this year were overpaying for this business. But there has been two parts of the business that, and this is, I guess, going back to your original question, that we sort of learnt about was, firstly, this is quite a capital-intensive industry. We heard Greg Goodman talking yesterday about the challenges of building data centres. Macquarie Technology is going through a very capital-intensive part of its journey where it's building its biggest ever data centre in Macquarie Park, spending $350 million building this centre called IC3. And so all of the profits, etc., are getting recycled into building out this asset, which will then take some time to fill out with tenants and servers. And so, it's a time when you're not seeing a lot of earnings growth in the stock. But if step back, this business has grown its earnings every 6 months for the last 20 successive earnings reports. There'd be a handful of companies on the Australian share market that could say that they've achieved something like that. The other part, Nadine, is that, as you said, government, where this company has put a foot wrong, I think, in hindsight, is government are principal tenants of these data centres, which is ultimately great. But what governments did coming out of COVID was that they digitised far quicker than expected, and that was because of all of the rules at the time. So driver's licenses went online, et cetera, et cetera. And what that meant was that the data centers were filling up quicker than expected. And at the same time, Microsoft and Amazon that store this data in the cloud were ratcheting up their prices faster than expected. And because the contracts are typically sort of 3 to 5 years with government, they weren't able to pass these faster than expected price rises that they were getting hit with onto their customers. But we're now sort of 2.5 years into what's been a more difficult time for them. Those contracts will start to roll off, and we should start to see the company take back some margin.
And so you've got faith that that David Schuderhope, with his 41% ownership of the company, is going to make this work.
I think so. Yeah. I think this is someone who has an incredibly good track record of delivering on what they said and being very honest. A couple of years ago, he said, this is going to be a tougher time to grow earnings. Yeah. And we heard that. And so, the stock was nearly at $100 at one point 6 months ago. It's now down at 60. So it's had a serious pullback. And really nothing changed to move it from 60 to 100, and nothing's changed to move it from 100 to 60. I think it's like everyone trying to find the data center operators a year ago, and then, a bit of a dose of reality about these aren't the easiest things to actually build, and it takes time. Okay,
we still want you to restore our faith in founders, Ben, and you've put Pinnacle Investment Management on the list. So I've had the pleasure of interviewing Ian Macoun about Pinnacle itself, but also I heard him actually at a TMS event talking about sort of his journey and his beliefs and how he's running the company. So what do you like about him?
Well, I had a 1 hour one-on-one with him leading into that. And Pinnacle's been a business that I've looked on from the sidelines for way too long and admired. It's a business we know really well because our clients actually invest in some of the affiliates that they own components of. We know that their sales and distribution team is without doubt the best in the market. And we have seen this really incredibly good rise from Pinnacle. And so when I got to sit down with Ian, I mean, the biggest thing for me was just how humble he was, but also I think at 71, still so driven about where he wants to take the company to. And it was a great opportunity because I think within 3 or 4 weeks, it might not have been, it was maybe a couple of weeks later, the stock price fell from $26 to $16, $17. And I thought, finally, we've got an opportunity to buy them at a big dip.
So here, you brought up Mr. Macoun's age.
Yeah.
So because it is a umbrella, it's got the boutique, the affiliates underneath it, does that eliminate some of the key person risk, which we always talk about when it comes to, well, not just founders, but also fund managers?
Yeah, absolutely. And I think, so if you looked at Pinnacle even 3 or 4 years ago, it was very exposed to the performance of a small number of fund managers. And although it's turned out to be a great investment, profit has grown at 40% per annum for the last 8 years. So that's why the share price has been so good. If those managers hadn't performed as well as they had, it could have been a very different story. And I think one of the other reasons we really like it now is because what we've seen is Ian has diversified the fund managers out of equities. So they're in private equity, credit, they're in America, they're in the UK. So he's also diversified geographically. And now the ups and downs of the market aren't quite as much of a read through for what their profit's going to look like. And, I think Ian, he's I think wary about, it's ASX sensitive stuff, but I think there's a very good succession plan in process.
Okay, third on the list, Telix. So Christian Brennebrock, it's hard to say.
I know.
Yeah.
I was practicing that on the way in.
Thank you. I thought I'd wear it for you this time around. Founder, CEO. You actually couldn't get a better pedigree to run this company. He has been in biotechs, running businesses for so long. Yeah. And this is a crystallization, in my view, of sort of everything that's come before. Yeah,
and he's a 6% holder in the business. Was a bit high, but he had a reason to sell some shares in his personal life. But
okay, so let's talk about this.
Yeah.
Because this is one thing when it comes to founder-led businesses.
Yeah.
Is you can have the headlines selling a $120 million block trade of his own shares, and I think the co-founder as well.
Yeah.
For purposes that,
Makes
could
sense.
be tax, or it could be a divorce, or it could be whatever. But this causes the share price to fall. So isn't that a risk when it comes to founder-led companies?
It is, and it's not ideal, Nadine. Like, I think it's been well written that Christian went through a divorce, and as part of the settlement, he was a forced seller of those shares. The way we would like to see founders, it's completely understandable for founders to want, after maybe 20 or 30 years of a business, to take some money off the table and look to put into some other stuff. My advice would be the best way to do it is actually what Richard White has typically been doing, which is to say, and is far more prevalent in America, where they say at the start of the year or at the start of the quarter, the founders will be selling down X number of shares over the next quarter, and it's drip fed through every single week, and it's not a one-off thing where you think, because that sell down was done right after the February results. So that a trading window opened, and it always does make you think twice. So it's a risk. With everything there's risk, but I think you do have to look back and think, is there anything we're missing here if you see such an aggressive sell down? But I think the good founders, it's unusual to see something like that.
And so Telix, you're totally confident that it will continue to expand. I suppose was a relief in your camp when they've decided to abandon that NASDAQ listing and stay primarily listed here?
Well, look, this is one we only have just started buying recently, and I think they have had a bit of bad news in that. So for those who don't know, Telix provide the world's leading treatment of prostate cancer, and they also have 3 products coming through their pipeline, which should be selling in I would say the short to medium term, which is kidney cancer, brain cancer, and multi-skeletal condition. The brain cancer was seen as being the next one to get FDA approval, and it has been pushed out. So that has pushed out some of the analyst numbers as to when that's going to come in. I would say the company gave guidance for this year with zero assumptions of getting any FDA approval. The revenues of this business are growing 50% per annum, EBITDA 70% per annum. And the company's, what I like about this is it's a single product company. Now, we all know there's always risk with that. Mm-hmm. There could be a competitive treatment that comes through. There could be an issue with the treatment. The treatment's been selling for long enough now that I think you can be comfortable that it's, it's not going to have a problem there. But this company should be selling 4 products within the next 18 months, I reckon. And it's going to become more diversified, like a Pinnacle, say, very different area. It's going to be much more diversified geographically. It's very exposed to the United States at the moment, and the Trump rumblings have knocked a bit of sentiment out of the stock. But it looks quite reasonably priced for a business that's growing so rapidly, and I can't see that trajectory is going to change.
Okay, so 3 founder-led companies that you guys at TMS Private Wealth, have faith in going forward. I just want to be clear, you guys are not fund managers.
No.
You're wealth advisors.
Correct.
So you're stock picking,
yeah.
But you're doing what? You're putting it into a broader sort of picture for people?
Well, back in the 20 years ago when we started the business, at the time there were stockbrokers and there were financial planners, and we came out of a broking background, and our view was by charging an ongoing transparent fee, which was very rare at the time, but managing the money as a fund manager would, which removed a lot of costs by not having to employ a whole lot of fund managers, we could meet a lot of Australians' desire to invest directly. A lot of Australians like investing directly, and also get costs down. So, it's obviously evolved over 20 years, but the premise of our business has stayed the same. So we would see ourselves as doing what fund managers are typically doing. We go on analyst tours, we go and see management. We've got enough funds under management where we get access to management these days, but we do this individually for people, not in one big box that everyone just has to put their money into.